Options pricing, aka premium, can be divided into two categories: intrinsic value and extrinsic value. Intrinsic value. The intrinsic value is the amount the strike price is in the money compared to the underlying. A $9 strike call for a stock trading at $10 has an intrinsic value of $1 per share, or $100 per contract. Extrinsic value. The extrinsic value is the difference between the market price of an option and the intrinsic value. This is referred to as time value, based on a combination of days to expiration and IV. Catalysts like earnings report increase the IV, setting up options to IV crush after the catalyst is over.